Imagine you are standing at the center of one of the wealthiest countries on Earth, a small landlocked nation of roughly 660,000 people wedged between France, Belgium, and Germany, where the average salary is among the highest in the entire European Union and where the cost of simply existing quietly consumes that advantage in ways most people never stop to calculate. Luxembourg is not just a rich country, it is a financial mirror. And depending on where you stand inside its economy, that mirror reflects an entirely different reality back at you. At the bottom of the income ladder, earning somewhere around €2,000 to €2,500 per month after tax, life in Luxembourg is a careful and unrelenting exercise in arithmetic. Rent for a modest one-bedroom apartment on the outskirts of Luxembourg City will consume roughly €1,200 to €1,500 of that income before you have purchased a single meal, paid a utility bill, or set foot on a bus. What remains is not a budget, it is a tightrope, and every unexpected expense is a wind gust. People at this level are not failing by any global standard, because €2,000 per month in Luxembourg is still a middle income in most of the world. But the psychological experience of scarcity does not respond to global comparisons, it responds to local ones. And locally, this income level produces a persistent, low-grade financial anxiety that shapes every decision from where you shop to whether you ever consider saving at all. Move up to the €4,000 to €5,000 per month range, and something interesting begins to shift. Not dramatically, but measurably. Rent becomes a smaller fraction of income. Groceries stop being a source of stress. And for the first time, there is a margin, a small buffer between what comes in and what goes out, that, if managed deliberately, can begin to accumulate. People at this level in Luxembourg tend to own cars, take 1 or 2 holidays per year, and feel, in the common social sense of the word, comfortable. But comfortable in Luxembourg is a deceptive state, because comfort is not the same as progress, and most households at this income level are not building wealth in any meaningful structural sense. They are maintaining a lifestyle, which is a fundamentally different activity with fundamentally different long-term consequences.
The psychological shift that researchers in behavioral economics have documented again and again is that as income rises, spending tends to rise in near-perfect proportion, a phenomenon sometimes called lifestyle inflation. And Luxembourg's social environment accelerates this pattern precisely because the baseline of normal is set so high. A car is not optional in many parts of the country due to limited public transport outside the city. Private schooling becomes a social consideration for families. Dining, travel, and housing expectations quietly expand to match the income bracket of your peers. And before the arithmetic is ever consciously examined, the margin that appeared at €4,500 per month has been quietly allocated to maintaining an identity rather than building a future. At the €8,000 to €12,000 per month level, which captures a meaningful portion of Luxembourg's financial sector professionals, senior civil servants, and established business owners, the mechanics of wealth finally begin to work differently. At this income threshold, the fixed costs of living, housing, transport, food, utilities no longer scale with income. A family spending €4,000 per month on living expenses and earning €10,000 per month after tax has a structural surplus that, if invested consistently over a decade into index funds returning a historical average of 7 to 8% annually, begins to produce a compounding curve that eventually generates returns larger than most people's salaries. This is the threshold where money begins slowly and quietly to work instead of simply being spent. But even here, in the upper income corridors of one of Europe's most prosperous economies, the trap of visible wealth operates with extraordinary efficiency. Luxembourg's proximity to European financial culture, its density of high net worth individuals, and its real estate market, where average property prices exceed €1 million in many districts of the capital, creates a comparison environment where €10,000 per month can still feel insufficient, where the psychological finish line keeps moving, and where the decision to invest aggressively competes constantly with the social pressure to consume visibly. At the apex of Luxembourg's wealth distribution, among the private banking clients, the holding company directors, and the families whose assets are structured across jurisdictions rather than held in salary accounts, money has ceased to be an income question entirely and has become a systems question. How assets are structured, how tax efficiency is maintained across borders, how generational transfer is engineered decades in advance. This is wealth operating at a completely different frequency, one where the primary financial skill is no longer earning, but preserving, multiplying, and transmitting. What Luxembourg reveals across every one of these levels is not a story about a specific country. It is a story about how the experience of money is almost entirely relative, how the psychology of scarcity and the psychology of sufficiency are both constructed by the environment around you rather than by the absolute numbers in your account, and how the gap between earning well and building wealth is not closed by income alone, but by the moment a person stops spending to match their environment and starts building a structure that will eventually make the environment irrelevant. The country changes, the levels change, but the mechanics and the psychology underneath them remain almost exactly the same.